Hello, everyone, and welcome to the Suzanne and Sarah YouTube channel. I'm Suzanne Moore, realtor here in beautiful, sunny Bend, Oregon, and sometimes beautiful, sunny Baja with Realty One Group Discovery. And I'm also the founder of the Central Oregon Investor Network, which brings together investors not only from Central Oregon, but from all over the country to share ideas, resources, and create more freedom in our lives through passive income from real estate investments. So today we are going to talk to you about how to unlock creative financing for your real estate investments. The first route, traditional bank route. I know you might be thinking bank loans, that is not very creative, but hold on, because in the traditional world of bank loans, there is room for creativity. I can tell you from personal experience. So let's talk about some of the options. The first one is an FHA loan, and these loans are insured by the Federal Housing Administration, and they're great for first-time home buyers because they require a smaller down payment. They offer generally really good terms for interest rates, and they are fixed interest rates, and they are a long-term loan. So you generally would get 30 years if you're looking for the longest term loan. And you don't necessarily even have to be a very first time home buyer. If you haven't bought a home in a bunch of years, you probably still qualify for FHA financing, and it could be the best route for you to go. Now, next up is VA loans. So this is exclusive for veterans and armed services personnel, and VA loans can be obtained with as little as zero money down. Why is that important? Because you save cash for other things, like maybe you're rehabbing a property or you're flipping, and because you have VA benefits, you can get a VA loan with zero money down, so you have more money to use in your rehab. So they also oftentimes have very favorable terms and often are assumable loans. So you might even be able to assume an existing VA loan at, say, 3% interest, which when are we ever going to see that again? Or in the future, your loan could be assumable by another person with VA benefits. So lots of creativity that can happen with VA loans within the traditional bank sense. The next one is conforming loans, and these basically follow the guidelines that Fannie and Freddie set. So you can get creative here by initially purchasing a second home using just 10% down, using it as a second home for a while, and then maybe later you convert it into an investment property like vacation rental or a long-term rental. So then that way, instead of putting down 25% for your vacation rental or your long-term rental, you only have to put down 10%. So it's all about your intent. Or maybe you buy something and you live in it for the first year with your low down payment as an FHA buyer. And then after a year, you're like, actually, I'm ready. I did a live and flip. I'm going to rent this thing out and buy something else. So you can keep rolling on that owner-occupied financing year after year as long as you live in the home for 1 year. It's amazing. Okay, so now let's get into some more creative stuff. One is DSCR loans, and you may have heard of these. It stands for Debt Service Coverage Ratio, and these loans are really relying on the rental income from the property to qualify for the loan so that you as an individual don't have to. So it doesn't look at your personal credit, although it will take into account your credit score, but it's not going to look at your own debt to income ratio as much as it will look at the potential income that the property can generate from rents. So these are ideal for self-employed people like realtors or, property investors, real estate investors, or those with unconventional income streams. So DSCR is going to be your friend. Okay, now the hidden gems. The best hidden gem, the thing that we love the most, is seller carry financing. And why do we love it? Well, it's not easy to find, but it is a hidden gem because it involves homeowners who own their property outright or have a minimal mortgage remaining, and they're willing to act as your bank. That means you get to bypass the traditional bank qualification process. You don't have to provide all the forms and all the things. There's so much paperwork with traditional banks for a good reason. And you get to negotiate all the terms directly with the seller. So you can negotiate interest rate. As of right now, April 2024, we just helped our buyers close on a seller financed property at 5% interest. We haven't seen that interest rate in like a year and a half, probably longer. You can also negotiate how much down payment you want to put down. Maybe you need cash for your rehab, or maybe you have more cash and you want to have a lower interest rate. So you can negotiate on all these terms. You can also negotiate on how long the loan is going to be. If you want it to be 10 years but amortized over 30 so your payments are smaller. So many great ways to negotiate here with seller financing. So these are great for real estate investors, first-time investors. We can walk you through this process. Okay, the next one is hard money loans, and it's not hard because it's hard to get. It's just the term that has come with this type of financing, which is essentially private investors who focus on more collateral, so the property, than they do on your credit history or your debt to income ratio. A lot of hard money lenders will want to see that you have experience as a lender. Generally, you use a hard money lender when you're going to be doing like a flip type of property. So they're really popular for those short-term projects like flips, and they're going to be more expensive than a traditional bank loan because it's a short amount of time. Generally, you only have a hard money loan for like 6, 9, 12 months, and then you pay it off. And you're only paying interest. For most hard money loans, it's interest-only payments. You get a lot of flexibility in exchange for that higher rate. You get a quicker approval process. Oftentimes you can, write an offer as cash with hard money because you can close in like a week, oftentimes with some of these hard money lenders. So if you're experienced in real estate, and sometimes even as a newbie, hard money can be a really valuable tool. The next one is private money. So the difference between hard money is that's sort of like a group of investors that work with someone who brokers these deals out. Private money comes from your network, so your family, your friends, your circle of influence, your coworkers, your former coworkers, or other individuals you know who are looking for investment opportunities and a way to make money on their money. It's got to be worth their while, so it's got to be at a rate, an interest rate that's higher than what they would get at the bank. So as of April 2024, a lot of private lenders are charging 10 to 12% interest, but it's only for, maybe up to a year, sometimes 2 years. It depends. Again, you get to negotiate all those terms, and they also might be more willing to work with beginners if this is your first time doing a flip or an investment property. If they know you, trust you, like you might be able to get them to help finance your first deal. So you want to build and nurture those relationships with these private money lenders because you never know who's going to be your next person to save the day so you can buy the next deal and make money in real estate. So let's talk about some bonus ideas that have gained traction recently. You've probably heard of subject to financing. This is not assuming a loan. Subject to is different. This allows you to buy a property subject to the seller's existing mortgage. And while it is legal, it does carry the risk of triggering the due on sale clause that is part of most traditional loan documents. So that is just something to be aware of, but if executed correctly, it can leverage those amazing low interest rates that are out there on existing mortgages and help you secure a deal that works for you financially. Another one is self-directed IRAs. So if you worked in the corporate world for a while, you can roll over your 401k or an IRA into a self-directed IRA that allows you to invest in real estate. So all the rental income and profits go into the IRA, which grow tax-free, generally depending on what kind it is. So you can secure what are called non-recourse loans and increase your buying power using self-directed IRAs. And then finally, we have portfolio loans. These are in-house loans that are offered by banks or lending institutions like credit unions, and they don't conform to Fannie and Freddie guidelines, and that basically gives those lenders more flexibility on the terms that they offer and your, determining your credit worthiness. And they're particularly helpful when you have a substantial real estate portfolio. So for someone with, kind of getting up to that threshold of 10 individual loans with Fannie and Freddie, you might need to think about getting a portfolio loan to cover all of your mortgages, and that would just be a good idea for you to explore. The interest rates might be higher than what you currently have on your property. I can say from personal experience, that's where I am. Hard to let go of those great interest rates from 2021, but it is an option. So thank you so much for joining us today for Unlocking Creative Financing, a guide to real estate investment financing. We're looking at everything from getting creative within traditional finance to seller finance to some of these other bonus opportunities that you have. And if you have questions, you can contact us. Our information is in the notes below. And if you like this video and got something out of it, please like and subscribe. Thank you so much. We'll see you on the next one.